If you have decided that the government military survivor benefit plan is not the best way for you personally in your situation to defend and protect not only your military pension should something happen to you, but also potentially duplicate the benefits that you can get using a more modern approach, a more modern strategy that fits to your particular situation. So if that's you, then you're probably asking the question, how do I design a better private survivor benefit plan alternative? And so that's what we do at US Vet Wealth with the military pension protection system, using a combination of the defensive coverage, defensive insurance, and offensive insurance, which we call the private pension insurance, because really it's not insuring your life, it's insuring your income producing potential. And the whole point of saving money is to produce income. That's what a pension is. It's a form of income. So when you can privatize it, you have more ownership, you have more access and flexibility, and ultimately that means you can get greater profits. So that's what this video is about. Stick around and we'll get into it. Okay, before we get into the new military pension protection system at US Vet Wealth, I want to remind you that this is a part of the overall military retirement blueprint. This is the foundational thing that, and the first thing that you as a military retiree can do to make major but significant improvements that can give you more flexibility and access in those first 5 to 10 years after military retirement. We're trying to speed up how long it takes to achieve that autonomy and work life balance. If we can do that sooner with more purpose behind it, then I think that's what most folks are looking to do in post-military life. So that's a big goal of ours at US Vet Wealth, and really what the unconventional military retiree blueprint is all about. So let's take a quick reminder look at what we talked about in the last video, how the typical whole life and low cost term type of insurance policies aren't going to solve the problem of maximizing your military pension and getting you the highest probability of return on investment. And why is that? Because they're all 100% defensive with maybe a little bit of return of premium is the idea. Kind of best case scenario, if you need the money while you're still alive, is maybe you get some return of premium, but it's really hard to build any significant wealth. And that's why you end up having to take all the risk with your retirement accounts over in the stock market. The idea here is, again, we're creating a private pension. We're ensuring the income producing potential of your life. That means we're protecting income streams, both present and in the future. That means protecting assets that you've saved that were meant to create an income stream. That's why using this approach, it works so well as a survivor benefit plan alternative. But really, this is just introducing you to what is the private pension insurance, right? That's the offensive side of this. So we'll talk about both offensive, defensive. Okay, what do we mean by defensive? It's avoiding loss. Okay, so there's lots of different ways to avoid loss. For this particular use case, survivor benefit plan, protecting a pension, we're talking about replacing the military retirement pay specifically, right? The survivor benefit plan only covers half of that pension, 55%. It does not include VA disability, and of course, doesn't include any post-military income. So we want to think about bigger aspects of what might cause loss. Taxes will cause loss. Investment losses, having to use money too early with penalties, that might cause loss. Cost is loss. Tax is loss. So we're mitigating all of that. We're just simply starting with the idea of, okay, the worst loss is an early demise, a catastrophic event, how we refer to as the get hit by a bus scenario, right? Highly unlikely. And unfortunately, how the vast majority of anything around insurance and life insurance, especially, is sold and bought. It's based around fear of highly unlikely scenarios occurring. So, what if we can You cover that with a defensive coverage. Um, Take the low cost approach, the highly unlikely approach, and just recognize that for what it is, but manage it much more effectively. And we can do that with what are modern versions, improved versions of term insurance policies. Term meaning it has a specific purpose. Term insurance is the defensive portion of this. This is what covers the higher death benefits required during these periods of life where you're in transition. There's change. Kids are growing up. You're buying and selling houses, properties, maybe starting businesses. You don't know until you hit that later stage of life when you're like, hey, I am retiring. I'm doing the second retirement. Remember, we say in the other videos that most of the financial planning advice that's been given to military people has been for the wrong retirement. We've saved all of our money for something so far away when the real opportunity is now, is getting out of the military and maximizing the financial strategy there. And so given that all of a sudden you're going from an average or pretty good income environment to a potentially a high income environment, the idea of what kind of protection do I need changes, not just because of what I want to make sure my family is taken care of with, but needs on maybe business or tax needs or other types of investment protection needs. If you're using a life insurance strategy for that, the only limitation on how much you can participate, other than your health status, is how much overall death benefit you essentially have access to. It's almost like credit. When you're applying for credit, how much do you even have access to? You might go out and apply for $1 million VA loan, and the bank comes back and says, we'll give you 750. That's it. That's essentially, you want to know, based on your current health status, what is the total maximum amount of death benefit you could get covered if you wanted it or needed it, either on day one or from day one till year 10, and then maybe you drop it off. You'll see what happens down the road. With traditional term insurance policies, you're locked into whatever amount of coverage and time frame you have, and you can cancel it, but that of course doesn't solve the problem, and when it runs out it doesn't solve the problem. So what we're doing here is getting the same high death benefits and low costs. Prices really don't change all that much, other than we want you to have a little bit more skin in the game because we want some convertibility. You will want to keep that death benefit that we might need down the road, and it would be much more expensive and maybe impossible to apply for it down the road. If some sort of problem happens later in life, that means you wouldn't be able to get more if you needed it. And of course, that's the problem that we talk about that backfires with the service members group life insurance, SGLI, because folks go their whole career thinking, oh, I'm covered with the insurance. I'll deal with that when I get out of retirement. And then they go through the VA disability and something comes up, and now they can't get anything other than the VGLI. Our ability to guarantee convertibility during a certain period of time just gives you more flexibility. And that's the main thing. It allows us also to start at a lower cost. While you're in transition, you can do an alternative that is going to be a lower cost option, survivor benefit plan and VGLI, far lower. Lock in higher death benefits if you want. So there's some levers to pull there, whatever your priorities are. And then, even though the coverage ends, you got some flexibility on if and when you want to extend it or convert it to what we call the offensive portion of the plan. Okay, and on the offensive side of things, what's the point here? As we talked about, it's the probability of getting a positive return on investment. And with insurance, there are guarantees based on the contract claims paying ability of an insurance carrier who you have the contract with. Then there's a promise of a guaranteed return. When you look at insurance companies compared to banks, they've been around for decades longer, many times 130 years, and they don't take the leverage and the risk in the short term that banks are forced to take to keep their shareholders happy. Insurance companies are playing multi-decades long games, and so they're taking low risk. They also have to keep large amounts of your premium dollars in their what's called a general account. They have to keep that money on hand because they're regulated, and they have to be able to pay out death benefits. So they can't reloan it out like banks do and all sorts of loans and mortgages and stuff. So It's a very safe place to keep your money, but safe usually means there's not going to be a whole lot of rate of return. So the fact that you are a mutual owner with the insurance company in your policies also has you on the same side of the table with the insurance carrier. They want to secure your assets because this is all mutual arrangements, contractual guarantees so that everybody benefits. They know they're using your money, promising you bigger benefits later. But the attractiveness in the offensive side of things, when I say attractiveness, I mean they needed to attract business. They wanted to attract business away from banks. As in the 80s and 90s and 2000s, when everybody was putting money in real estate and Wall Street investments, the insurance companies had to innovate too. They had to add some offense. But when they were adding offense, they said, well, actually, we're insurance, we're defensive minded. Why don't we buy insurance on the stock market for on behalf of our clients using what are simply 1, 2, and maybe 3 year long-term futures or options contracts. And so an options contract is an insurance contract on the stock market. If the stock market goes up over a 1 year period, you execute the option, you execute the contract, you get the profits. And if the market goes down over a 1 or 2 year period, you just don't execute the option. That's the insurance. So that's the cool thing insurance companies can do when it comes to investment that can't happen in really any other type of financial vehicle. So let's take a look at the main features of the offensive type of insurance, which we refer to as private pension insurance. And so how we design this is we're focused on over here on building the equity, getting the return on investment that we talk about. So what's the best way to get return on investment is to keep the costs low. We want to keep the costs low because just like with a mortgage, the lower the interest rate, then the more equity you're going to build inside your house, right? Or the quicker it's going to pay off or the less overall cost involved. The cost is always dependent upon how much death benefit is being purchased. So again, that's why we do the death benefit on the defensive side to keep the cost super low. The only reason we're doing any sort of insurance here on the offensive side is because life insurance is tax free. Life insurance can do that insurance on the stock market, a type of investment approach. Life insurance has legal benefits. Life insurance has liquidity, something you can get access to and have some flexibility. So that's the type of advantage that you can get with this type of strategy in the near term between military retirement and as you're progressing through a new career versus having to wait until after age 60. So we want to keep the death benefit on the offensive side as low as possible because the rules around life insurance gives us these different advantages. And so by keeping it low cost, we can manage the whole program. If we need more death benefit on the offensive side, we can take that from the defensive side at a future date and time because you're already qualified. But why would we want to bring more death benefit over? Two different reasons. One, you want to increase the permanency of the death benefit side of things. So there is a death benefit component. That way we have the same permanent uh, coverage as you would with a whole life insurance policy. But we can manage the cost so much better and reduce those death benefits later on if you so choose. And that altogether enhances the overall access to the cash equity. Unlike a mortgage and unlike whole life insurance, which is going to take 10, 15, 20 years before any real equity gets built up, we get access to our equity up to 90% of it as it's going in. The rest of it stays in the policy to make sure that it's being paid for and taken care of. But either way, no matter what the scenarios that play out in the future, we can guarantee that you have a lasting legacy. Your family will be taken care of if you have an early demise. And of course, you leave something behind, whether that's the full value of your pension, some other value amount. Really, you have the flexibility to do all of the above. So, how does this work? How are you funding it? How are you growing it? How are you actually getting to use it? Because ultimately, at the end of the day, this is an account with your money in it, no different than any other account that you have money in that you can access at a later time for some. There's different rules around all these different accounts. Retirement accounts have certain rules. Bank accounts, of course, seem to be the easiest, the most flexible, but there's certain rules around different types of banks and savings accounts. And with an insurance account, you're just having an account with the insurance company. There's not exactly an ATM card, but there are ways to transfer the money in and, of course, transfer the money out using simple things like bank withdrawals or even wires, right? You have a contract with the individual carrier, same as you would for a mortgage or any sort of business transaction. You're going into a partnership with the carrier rather than buying their policy. And when we're simply upgrading the strategy of how we're using the life insurance, we're going into a business transaction, a private contract with a carrier. In this case, personally, US Vet Wealth is the broker. I'm bringing the two parties together who didn't know how to find each other otherwise, or of course, don't know how to adjust the variables to make themselves work together more efficiently. We figure out the variables as you're applying and seeing how much of that death benefit you want, what your health status is, how you want to fund it becomes the most important aspect of this. And the way we look at this at US Vet Wealth, let's just do apples to apples. What would have gone into survivor benefit plan? So that same amount that would have gone into survivor benefit plan, we'll just use that same amount to fund this whole strategy, both offense and defense. And remember, our defense is designed to cover not just half of your pension, like the survivor benefit plan. We're aiming to cover up to the full pension and the VA disability if you so choose and can, of course, get qualified for it. So that's the defensive side of things. But on the offensive side of things, it's all about funding. So if we're just using dollar for dollar the same amount that would have gone into survivor benefit plan, let's do it in a shorter amount of time. Why? Time value of money. And that's the first thing you learn about investing. I think the rule of 72, you get excited, you hear that, wow, if I can invest and get a certain rate of return, my money will just double. If I get 7%, it'll double every 10 years. That's amazing. So that's the whole concept around financial planning. Sooner you get your money working for you, the better the rates of return are going to be. And maybe that's true. And if we get a rate of return with this strategy, that'll be a bonus. That's exciting. When we do the illustrations, we always illustrate 5 to 6% rate of return, being super conservative and just really assuming that the growth rate on our strategy is a bonus. We're more excited to get the money back and get tax benefits because that's still at the end of the day is going to give you a much greater return on living benefits if you don't need it for because of an early demise, right? So that's what the funding of the opportunity is about. It goes inside of an account. It's an insurance account. It can be invested in multiple different ways. You can have it in a fixed account with 3, 4, 5% growth rate on a guaranteed basis, or you can have it in what we call the indexed accounts. And this is where we're doing the insurance on the stock market indexes. And that's the better growth rate opportunity because we're basically getting up to 80% of the performance of the stock market, but no downside risk, right? So it's a really good trade off, not the place to put all your money, but it is a place to put lump sums if you want to protect other assets that were at risk in the stock market or some other profits from businesses or real estate sales, and you want to put it somewhere where it can grow tax free using this type of investment strategy. And this is the perfect place for it. And oh, by the way, that could also double as essentially the premium to fund the both offensive and defensive portions of the insurance contract. In that way, you could free up your cash flow. So, however, this gets funded, whether it's coming out of your monthly retirement pension, or maybe you're taking your tax free VA disability payment and putting that directly into a tax free investment. And that money would never, ever get taxed whenever you used it. So, not on the growth or on the withdrawals, no capital gains, no dividend taxes, nothing like that. So a lot of different ways that you can fund it. If you do it dollar for dollar, what would have gone into SBP, you could do more, you can do less. That's the flexibility you have using this type of account, assuming you want to do some sort of offensive portion of it. But ultimately, the whole point of saving money for the future is to use it. And this is what frustrated me about the conventional financial advice, investment advice, retirement planning advice model is that it's always about waiting, saving and waiting, save more, wait more. You earn more so you can save more. And as the person that was supposed to be giving this type of guidance, I got frustrated that I couldn't just say, well, when do you get to use the money? Here, think about ways to use it so you can achieve the more work-life balance, so you can have more autonomy, so you can do some cool things after you retire from the military, things you've been thinking about, and not feel that you're going to be locked into a new career for 10, 20 years. Maybe you can't use it right away. Maybe you can't use it right at retirement. Maybe it takes a few more years. But the fact that there's no penalties, there's no taxes, you can access your money at any time for any reason from inside these types of accounts. You can't do that really with any of the retirement accounts. You can't do that with real estate money. So the flexibility to have some money in accounts. Again, this isn't supposed to replace a checking account. This isn't supposed to replace all of your retirement savings, but it can essentially do an in between. Because what if you want to retire before age 60? You're going to get penalized with other types of accounts. So this is a place to play catch up. If you need to play catch up for aggressive savings, or if you have extra profits, if you want to reposition assets to manage taxes, longer term taxes more efficiently now while tax rates are low. These are things that we'll discuss in the design portion of how we're setting up your particular strategy. But ultimately, we're more excited about eventually how and when you can use it. If it takes a few years to fund it and let it marinate and grow a bit, that's okay too, because you won't have to wait 10, 20 years to get value from it if you need it. Either way, it's still funding a permanent type of life insurance that makes sure you're leaving a legacy, but you can manage whether or not you keep that, reduce it, or do whatever you want later on. You're not locked into a plan on day one. And that's really what our whole system is about, doing the offensive defensive versus the primarily defensive approach of the other plans, obviously with whole life and universal life policies. You can get decent offense, at least getting some money back offense, but you really can't do enough defense at all. And now that there's new technology, basically new software, really in life insurance, this type of life insurance is a software program, lots of variables going into it. And so managing those variables more efficiently means more growth. So just like you would do as your variables in picking a mutual fund, or who's the money manager, what are the costs, and of course, what are all the stocks that they're picking for that mutual fund? Who are all the managers of each of those companies that are running the stocks? There's just so many layers in thinking about any sort of regular retirement investment. Versus here, we just cut out a lot of the layers and bureaucracy because it's all just based on a couple of things that might potentially happen in the future. And we just are hedging the bets with insurance. Again, the main catastrophic event would be an early demise, and we need to replace large amounts of income, $33,000 a year. If we're talking about a typical '05 retiring, won't cover the spouse's income very much, versus maybe a $2 million death benefit lump sum would be a better approach for that. But on the flip side of things, that same '05 would be committing something like $150,000 into the SBP if they don't pass away early. In which case, and if the spouse passes away first, there's no money coming back. And of course, it's only covering half the pension, and no long-term care benefits, no disability benefits with SBP or the other life insurance programs. So that's why we're excited to launch the pension protection system for those who qualify, for those who feel a little bit like the conventional path isn't right for them. We can bring this for the first time to the military community. I've been doing this for over a decade on a small scale. I didn't realize how few people were having the opportunity to take it. We're really missing it because 80% of retired military end up doing survivor benefit plan. So by working with us at US Vet Wealth, we will work with you and help you design a private military pension protection system alternative using both the defensive insurance and the offensive private pension insurance strategy. What we do is help you get qualified, go through the process, and make sure you're set up. And first and foremost, can you get qualified to be able to decline the survivor benefit plan? We want to help you answer that question first, but also make sure that you're getting the highest probability of a positive return on investment, getting the most bang for your buck. And all of this, of course, is part of the overall military retirement blueprint to give you more ownership of your military benefits, give you more access to post-military opportunities, and ultimately profit the most from your time, your talents, and your treasure so that you can achieve autonomy in the work life balance and post military life that you've been waiting for. And we can get all that inside our new program at usvetwealth.com/blueprint, where be sure to log in and join us and sign up to join us for our weekly live calls. Because in the weekly live question and answer calls, we will answer all your specific questions about this decision around survivor benefit plan and other topics as well. We schedule those out as requested, but specifically, of course, every week there are more and more people retiring out of the military who are finding out about this for the first time. And so that's the idea. So sign up, bring a friend. We can answer your questions together. It's good to be in a room with other people asking questions because you might hear something that you weren't thinking about that might be relevant to your situation. And of course, your questions will be helpful to others. So that's the idea there. It's a safe space for you to ask the important questions around this important and sensitive topic, as it can be in some cases. We look forward to seeing you inside. Always feel free to hit me up on LinkedIn, Scott R. Tucker, and ask me questions there. But thanks again, and we'll see you on the next video. If you found this video helpful, then make sure you check out our new guide, Navigating Your Military Retirement Pay and Benefits. Visit our website, usvetwealth.com/retirement pay, so you can get access to our free information resources.